Why your bank app feels like a game feels normal, but it is rarely accidental. The design dictates the flow of your retail capital. Legacy banking was defined by high friction, static environments that required deliberate, slow interactions with ledgers and physical documentation. Modern financial interfaces have replaced that friction with a dynamic paradigm, pulsing with progress bars, push notifications, and celebratory animations. The industry argues that this shift serves the user by simplifying complex markets and lowering the barrier to entry for millions of people. Proponents claim these features improve retention and increase financial literacy by making the abstract process of saving and investing more engaging. However, viewing this design solely as a tool for user empowerment ignores its secondary, and perhaps primary, function. Regulators and behavioral scientists identify these interface choices as digital engagement practices, or DEPs. DEPs represent a transition from providing a neutral financial utility to deploying active, engineered behavioral interventions. These interventions are designed to purposefully alter the timing and volume of retail capital moving through the market. Modern retail banking apps function as active participants, purposefully built to guide user behavior towards specific financial outcomes. To drive this engagement, platforms utilize gamification, the integration of game design elements into non-game contexts to manipulate behavior. This nested relationship illustrates how broad engagement practices facilitate targeted behavioral techniques. Gamification sits at the center, functioning as the trigger point where dopamine design intercepts the brain's reward pathways. The first component is anticipation. Platforms prompt users to expect a reward, creating a continuous loop that keeps them returning to check the app. The second is variable rewards. By offering unpredictable payouts, like a surprise stock or nominal points, platforms mimic the addictive mechanics of a slot machine. The third is instant feedback. Immediate visual or auditory cues provide instant validation for a user's actions, reinforcing the habit-forming loop. These rapid, emotional feedback loops directly conflict with the slow, deliberate logic required for sustainable financial planning. The interface trains the user to react to platform stimuli, regardless of whether that reaction aligns with a sound financial strategy. Behavioral theory can be confirmed through empirical evidence, specifically through randomized controlled trials conducted by global regulators. The Ontario Securities Commission provided a primary proof point through a recent large-scale experiment. Researchers split participants into a control group using a neutral app and a treatment group using a version enhanced with gamified prompts and leaderboards. To test the effect on behavior, the OSC introduced a treatment variable, awarding points every time a user executed a trade. These points possessed absolutely zero real-world economic value. Despite having no financial value, the points were highly effective. Users exposed to them increased their trading frequency by 39%. Further evidence comes from the UK's Financial Conduct Authority, which studied the impact of push notifications and interactive features. The FCA found that these digital engagement practices actively degraded the quality of user decision-making. Their data showed an 8% shift of retail capital into risky assets when gamified features were present. This impact is disproportionately concentrated in vulnerable populations, with younger users and those with lower financial literacy being the most susceptible to these nudges. These interventions override rational financial planning, generating massive, measurable changes in human behavior through rewards with zero underlying value. This data prompts a fundamental question. Why would a platform intentionally engineer a 39% increase in user trading activity? Increased trading frequency statistically leads to poorer outcomes for retail investors due to the costs associated with frequent, poorly timed buying and selling. These platforms prioritize high-frequency volume over the long-term health of an individual user's portfolio. This volume drives the platform's revenue through a model called payment for order flow, where the firm is compensated for routing user trades to specific market makers. The app interface is merely the surface layer of a massive order routing machine. Every behavioral nudge that generates a user tap translates into retail order flow. When a user reacts to a notification, the gears of the platform's revenue engine begin to turn. This dynamic creates a systemic, engineered conflict of interest between the platform's business model and the user's financial well-being. Gamification persists because it aligns psychological manipulation on the screen with the platform's mechanism of extraction at the foundation. When millions of individual investors interact with these gamified systems at once, their capital and attention are funneled into synchronized patterns. This creates a significant asymmetry in leverage. Individual investors attempting to stick to a personal plan are competing against a platform optimized to distract them. Global regulators like the OSC and FCA are now scrutinizing these practices precisely because of this imbalance. The core of the regulatory concern is that digital engagement practices blur the line between a neutral software tool and active financial advice. Using a variable reward to successfully push a user into a speculative asset operates as a de facto investment recommendation. Large-scale synchronization of retail psychology alters the very nature of how individual trades aggregate within the financial system. Fintech interfaces function as sophisticated harvesting tools designed to extract maximal value for the platform. So the effect is not random, it is structural, and now you see it.